We're officially live on YouTube for the Thursday edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. Today we have a very special co-host because GC is off with his business partners doing some business partnery planning stuff. We got the MVP of the community, a man you may have heard of, a man you've definitely heard laughing if you've ever heard him, Lee MVP Bishop. Welcome to the show, my friend.
Thank you, Pablo. Always great to be here at the JWB Income Property of the Week.
And our fabulous community manager, who we like to call MTM because she brings us the moments that matter, and because her name is Madison the Magnificent. Welcome to the show, Madison.
Hi, everybody.
And if you are joining us on the podcast and you don't know what the heck is going on, or you're watching on YouTube, you're like, how do I connect with these crazy people? All you got to do is go to nyais.com, register for one of our live shows. We do it on Tuesdays and Thursdays. We have like a real live community right now already in the chat, checking in with us. And then you get to be part of what, Lee?
The roll call.
The roll call, baby. All right, we got Walt Hart checking in first. Walt, welcome to the show. We got the Ringmaster, Andrew Barnhill, checking in as well. We got Big Papa. We love it when he calls in. Big Papa, Jay Cohen, Greg's dad, with us as well. We got Joe Bussey's back. Joe, good to have you, man. You're becoming quite the regular over here. We got the mountain man, Billy Green from the Deer Stinky Mountains of Colorado. That's got to be some kind of hunter thing. Deer Stinky. You're a hunter, right, Lee?
Oh, yeah, I am. They got the deer piss they put all over you so you blend in with the trees, I guess.
There you go. We got Aaron O'Neill stepping into the lights. Aaron O'Neill, good to see you, Aaron, in the community. We got Denny Davis checking in with a Guten Tag from Switzerland. Guten Tag, Denny. Good to have you as well. We got Leo Faraganan. Faraganan. Leo, good to have you, my friend, from sunny Bay Area, California. Let's rock. We got Doug Lowenthal in the house. Doug, good man. Good to have you here. Doug used to, he had the company that runs JWB's IT, sold it recently. I think he's onto a new venture. Doug, great to have you in the house, man. Another engineer as well. Doug, if you want to be part of the show, just raise your hand and we'll bring you right up, buddy. We got Dean Curry in the house, the early bird, checking in a little later today, but good to have you, my friend. We got Nadeem Shah saying good morning, good afternoon from the West Coast. Nadeem, good to have you as well. We got Gerard Wendling. Hello, engineers and everybody else. Let me know in the chat if you're an engineer. I would love to know how many, because this is the data point that we're getting, is that a lot of the clients are engineers. So we're doing this show to have this conversation. We got Kelly Barenbaum, who is future star of the show, a financial engineer, right? She's a financial planner. She's coming on to tell us how financial planners think next week. We got Terry Ingram, technical specialist. Terry from Orlando checking in. Terry, good to have you back as well. Shelly Johnson, past star of the show, out of Denver. Good to have you, Shelly. Jeff Bolton. Good morning from California. Jeff, good to have you in the house. Oh, we got the first family in the house. We got the patriarch and the matriarch. Ken Moline, also an engineer, living in the land of engineers, Silicon Valley, first family. We salute you. Who else we got? Michael Santorios is back. Good to have you, Michael. And of course, the fairy godmother has joined us. Jen fills in from the beautiful Monterey, California. Jen and I had a nice long conversation last night. I heard you guys have had a couple of conversations recently, Lee, you and Jen.
Yeah, we're going to be doing some creative financial stuff with Jen so she can purchase her grandmother's house. This should be exciting.
Yes, and I did not mention the matriarch of the first family, Carolyn Moline. You were saluted as well, the wife of an engineer. Good to have you. And, once we get done with the roll call, which is our usual tradition here, we go into my favorite segment of the day. Lee, you know what my favorite segment is?
Madison Cares. No,
Madison shares good news, Lee. She's here to share good news.
But it does have to do with JWB Cares. So you kind of just lined me up for that one. All right, everybody. If you don't know, JWB Cares is the extension of JWB. It is how we raise funds, and through JWB Cares, we donate a house to a veteran who graduated from the K9 for Warriors program. In order to raise money, we put on one really big event, the JWB Cares Charity Golf Tournament. This year, the golf tournament is on May 1st, and it's usually just open to sponsors, people who pay money to play, some of our vendors, all in JWB team. But this year we are opening 50 spots for the public to come down and be a part of our cocktail hour after everybody gets done golfing. So after everybody gets done golfing, we hang out in the clubhouse, and we have food, drinks, we get to talk to people, network, meet new people, meet the team. So we are selling 50 tickets to the first 50 people. Tickets are $100 a person. And if this is something you're interested in, you can go to www.jwrealestate.com/fun. And I will put the link in the chat for you guys so you can see that.
That is so awesome. Madison, when is the golf tournament?
May 1st. It's a Monday.
May 1st, 5:01. And you said www.jwbrealestate.com/fun.
/fun.
That's what's going to be happening, y'all. I'm super pumped about this, Lee. We've tried to have, isn't it every year that we're like, man, golf tournament's here, but it's impossible to open it to other people. This has been like the solution of opening up the tent, letting more folks come. I know that you've been asking for it for a while, man. What do you think of this?
I think it's great news. I'm a golfer, but they say, I need to have 3 friends, and I just don't come up with 3 friends that can get in Jacksonville. So this is a good solution for that.
Yeah. I've for the last, since I've been involved here for the last 3 years, it's always been like, man, how can we incorporate more people, right? Like, I know that it's the sponsorships, the whole things are very, very expensive. It's always done for vendors, but we've been looking for a way to incorporate the community and provide a way for all of us to like be able to get together, come for a cocktail hour. Lee, you might be a golfer, but before you were a golfer, you were a party man.
Oh, I was a drinker always. Yeah.
So yeah, come by the cocktail hour. So that's awesome. Come to the cocktail hour. Go to jwbrealestate.com/fun. Join us there. It all goes to a great cause, right, Madison?
Yep. Everything goes to JWB Cares to help build that home for that veteran.
You know what I call that, Madison?
I'm guessing good news.
I call that good news. Thank you. Thank you for sharing. This is awesome. All right, Lee, let's get into this. Before we bring up the actual property of the week, I want to get into this mindset, something that we were talking about earlier. It feels like when we talk to folks about rental property investing, it feels like it's often like a very emotional decision. There's a lot of like emotionally charged things. And my thesis is that the reason why engineers are so drawn to this asset class and make up such a big part of the clientele is that they're numbers people. Can you tell me a little bit about how you analyze this thing? How do you, first of all, what do you think of that opinion?
Yeah, we always talk about it as a widget, and I know that there are a lot of people that look at properties and say, oh my God, I just love the color of that. The front door looks wonderful and all that. That is all emotion. And the way we want to help people get away from the emotion is to just consider it a widget, right? It's a money game. I shouldn't even say game because it's serious, but with JWB under promising and over delivering, it's not a risk. And so you don't want to be looking at this thing as a place that you're going to be living. I know Greg always says that, but that is when you are looking at it with your heart. You want to look at this place and say, can it make money for me? Is it going to be prosperous? Am I going to have to worry about what's going on in the neighborhood? And these are the kind of things that you research, right, before you purchase a place. But like I said, with JWB doing the hard work for you, it's just so much easier on your heart knowing that you got a team of people that are so, set for everyone to win, that you don't have to do all these analytical, things that I would normally do as a real estate investor. There's so many things that you have to be thinking about analytically to make this make sense. And really the only thing you have to say to JWB is, I want to buy a new house. I want to buy an old house. I want to buy a house that has this configuration, or I want to know, how many square feet, and I want to know what it's rented for, and what's the bottom line? What's it going to cost me, right? Because all of these things are the true analytics of what's going to make the property great or not. And what makes the experience of a total turnkey investment is your management team. And, if you've got a poor management team, you're going to think this is the worst thing in the world to get into. But because we know that JWB is not is just the exact opposite. Is a great management team. It just takes all the worry out and all the stress out, and it just makes it great.
Well, thanks for that. And you look fabulous in your JWB shirt, as Ken Moline is pointing out in the chat. Really nice commercial that you just gave for JWB. But talk to me about, you now have 5 rental properties. You got very educated in real estate, so much so that you've moved on to become a full-time real
Money
estate
lender.
investor and money lender and these types of things. When
Right.
you were first looking at these, we're going to go through your client journey. We're going to talk about the property of the week. But when you were first analyzing the first kind of like group of properties that you got into,
Right.
what were the decisions that got you there, right? Like what, first of all, like, how did you, as an engineer, think to yourself, I need to get into real estate, and then start there?
Well, to be honest with you, it was all about the new education I was getting as a real estate investor. Once you got into it and they started talking about asset protection and, no erosion of your, capital, the money itself, it really came down to, the education. And what they were teaching us is that you can get paid on a residual fee forever and enhance your retirement. And, all you have to do is come up with a way of getting into these properties and making them work. And when I got into the JWB thing, I thought, okay, I can invest in my retirement money, which was unheard of before I got into real estate investing and learning how to do it. And so that having the money in my retirement in a 401k and being able to establish a way of having a self-directed IRA that I could use to spend this money and buy houses, and then be able to buy the house with borrowed money in a retirement account. That was just mind blowing, right? Because I could afford so many more houses than what I was able to come to the table with, so like $480,000 was able to buy 1.25 million in houses. I mean, it's just, it's crazy, and it was unheard of. Right. So
Yeah.
the analytics of it was, oh my God, this, my wife is always saying, hey, slow down, Trigger, right? You bought one house. Let's see what Dad does. And I'm going, nope. Next month I bought 4 more. And she was like, whoa, are you crazy? And now a month later, she was saying, oh my God, why didn't I know about this?
So it sounds like there's a couple calculations that you had to make to kind of cross that bridge, right? Like, it sounds like you first realized that real estate was something that provided you a different type of, it sounded almost like you were looking for, was it more ROI? Was it just like getting your money out of the 401k, out of the stock market because you wanted better returns? Was it diversification? What was that first kind of like decision?
Diversification didn't have anything to do with it with me, although I did only take half of it out to see what the other half was going to do. And, you look and see, the buying a house is going, whoop, the stock market is going, there's no faith and I mean, as Greg always says, when you have cash flow, or even if you're breaking even in the first year, you're going to eventually have cash flow. And once the houses are all paid for, it's all profit, pure profit. So, I'm not putting really any more money into that account. And already it's just skyrocketing. It's with all 5 of the profit centers working for me, it was really a no-brainer. But to be able to come up with that concept or to figure out how to pay it all down, I mean, that was all part of the education. And,
Got it.
as the engineer, that's where it's all coming from. It's how much can you learn and put it into action.
So if I'm hearing you correctly, you first got attracted by the upside of real estate, and then you started getting educated, and then
Right.
you realize that on top of that, there's different levers that you can pull that help you engineer it further, meaning the leverage piece, right? The idea that you can take a certain amount of money, and with that amount of money make this, like this amount makes this much of an investment that you get to like live off of by taking out loans on your 401k,
Right.
doing all that stuff.
Right. And everybody's telling you, oh, don't take a loan out on your retirement account. You know, I mean, all of the things that I was doing, everybody is saying, oh, you shouldn't be doing that. And from an engineering mindset, you know, that if it makes sense to do it, why not do it? Right. If you're thinking about the money and how it's working for you.
Yeah.
It's not, you know, the naysayers will tell you every time. And, you know, oh, don't do that. Oh my God, why are you doing that? No retirement account should have a debt, you know, associated with it. And it's like, you guys aren't looking at the big picture. You got to look at the big picture. You got to see how this is benefiting. This whole process of investing in real estate with your retirement money or starting a company and investing in real estate, whether it's passive or active, it's all, you know, how you think about the money is going to be working for you, right? Not you working for the money. And that's what it comes down to when you retire. You want to be able to have your money working for you and not the other way around, because when you quit, there's no more money coming in. And then you can just watch it erode and have somebody saying, oh, you can't do that, you know, or you yourself say, I can't do that because I got to save for a rainy day. Or you have this continuous cash flow that's going to continue to come in every month like clockwork and not have to worry about where your next paycheck is coming from.
I'd like you to explain a couple of those concepts, Lee. First of all, we got great Q&A coming in by Michael Santorios, Kemeline, Bill Green. We're also going to dive into Lee's investor journey after we do the property. But you said two things. One is people tell you not to take a loan out against your 401k and they're thinking about it wrong, you know, like, and you think about it differently because you're an engineer and you're penciling things out and they make sense, you know, on the numbers make sense. How do those numbers why does it make sense to do it? And why are they wrong about that?
Well, I think just the general concept is, oh my God, why would you want to take a loan out on your retirement account? Even if you look at the IRA, the IRS is saying, what you shouldn't be taking out, taking out debt against your retirement account, because what happens if you can't pay it back? Well, that's not what this asset class is doing. So once you get over that hurdle that the tenant is paying the principal and interest on your loan, you're building up your cash reserves so that you can pay the interest, the insurance and the taxes at the end of the year. It becomes a no-brainer. I mean, really, the analytics is made easy for you. And JWB has a team that will tell you, you know, what you're looking out for and how much you have to have. So they hold your hand through this whole thing. I didn't say, oh, I'm going to rub a magic ball and let's just make sure this happens. The analytics, the trust in the team that you're working with, the people that you have to talk to understand what's going on are all there waiting to talk to anybody, right? And I mean, I felt so comfortable with it that I started talking to people about it, you know, on my own, that people had questions. Everybody has questions until they do it, right? The big unknown is because everybody's telling you not to do that. You know, that's the scary part, that people are telling you not to do it when it just makes sense to do it.
Yeah, that makes sense, man. You were talking about the wrong way of thinking, the loan out, and then there was another thing that I was going to ask you about. Anyways, let's get to the property. Ready? Let's talk about the property, and then we're going to dive into the community's questions. Michael Santorios has a couple of good ones about your thinking around the IRA. But for right now, we're going to magically whisk ourselves away to 5813 Pompano Drive, Jacksonville, Florida, 32277. It's a purchase price of $265,000. You can download this sheet in the chat. Madison just posted the link, or if you're listening on the podcast, go to jwbinventory.com and you can follow along at home. Purchase price of $265,000, monthly rent of $1,531, 6-bedroom, 2-bathroom, 1,656 square foot. Average duration of tenant stay, 4.5 years, thanks to having a great team and property management and the data flywheel. Annual appreciation rate that's best in class here in Jacksonville for cash flowing markets of 4.6%. And of course, what not your average investors actually are looking for here is this estimated IRR return on investment of 12.05%. Lee, when I show you this house on this thing, what's the first thing you start thinking about?
I have to be honest with you, it's not in my buying criteria, which I would be looking at.
Okay.
Whether it's new or not. The 6-bedroom is just too much for me. And that's just the way I feel about it. I like 3-bedroom, 2-bath. So a 6-bedroom, 2-bath, that's out of something I would even be looking at or considering. And part of that reason that I have a buying criteria is I want to make sure that if I have to, I can sell the house and people will be able to, that I'm looking for a bigger audience that will be able to purchase the house if I ever needed to sell it. That's why 6.2 would be not for me. But
Got it. So
that's
for
not
you,
to
so for you,
say-
floor plan makes a big difference to you, and interior layout makes a big difference to you. Why is that?
Well, like I said, 3-bedroom, 2-bath is a normal size family, maybe with, a couple and a kid and maybe an office. So somebody can work from home. 6 bedrooms leads to, an extended family situation maybe, or somebody with 4 kids, right? You still have an extra room, but the amount of people that are going to be living in that house is much bigger than I would prefer to be able to maintain my house in a living position and quality that I have when I do a turn, right? Because the more people you have in it, the more opportunity there is for something to go wrong. That's all. That's the way I'm looking at it, right? It's the analytics, right?
Yep.
I'm not saying it's bad for everybody. I'm just saying it would not be something I would look at, if I'm being honest.
So what are you were talking about, like, you have a framework for analyzing properties right now these days, right? Why don't you share that framework of what you look at?
So, Greg and you were always talking about the 5 profit centers, but if you look at the cash on cash returns, the cap rate, the rental property versus cash flow, the price to rent ratio, and the 1% rule. The 1% rule is a way for you to quickly look at multiple properties to see which one would be more profitable for you, as long as you're using, like I know Greg was kind of laughing about Renometer, but it's still a valid tool to use to see what the rent will be in an area. So if I'm doing it in Baltimore County or Harford County, they all might have different rates and everything, but that's where I would be looking. And these are the type of things on a buy and hold that I would be looking at to analyze a property more so than I would be looking at, JWB makes it easy because all you have to do is say, hey, this is what I'm looking for. I want to buy a house and I have this amount of money. And they can either put you in it or, work to see what they can do to get what you can afford. So I take all the analytics out when I'm working with JWB because I'm not going to be researching the neighborhood. I know that they have their core neighborhoods that they work in, and it works for them. And I know it's going to be a C-class neighborhood that's not full of crime, and the workforce is going to be there, and all the things that you guys always talk about. I don't have to worry about the analytics. In my real estate investing business, I do have to worry about that stuff, and I got to do a lot of investigation and then figure out what my exit strategy is going to be.
Yeah. So a different perspective for active versus passive.
Exactly.
Got it. Joe Bussy's got a good question here. He says, total newbie question. As interest rates sit at 6 to 7%, do the numbers continue to make sense on leveraged properties? What do you think about that, Lee?
I think whatever the interest rates are going to be, the time to buy is now. It's not yesterday and wait a year, right? It's now, because the interest rates, the Fed just raised the interest rates a quarter, right? 25, whatever they call that. And I think that the collapse of the banks was a direct result of the Feds playing with the money and the interest and everything. And then it got to where the T-bills were upside down and it caused those banks. So I don't think for the next 12 months that the Fed is really going to be doing a lot of raising in the interest rates. I think it's going to be steady for the next 12 months. So that's why I say now would probably be the best time to buy, even though we're the end of the JWB sale where he was giving it a discount on the property on the interest. I think you can still get a VA loan if you're a VA for 5.375 or something like that. And conventional loans were at 5.875 or something, I think I heard. But you can look that up at the bankrate.com or something and see what the rates are in the area or what you're gonna get, so you
Got it.
can find this information out.
Yeah.
You know.
And I'm gonna pull up the deal eval kind of like, so we go over the numbers, but my take on it, Leanne, you tell me
Yeah.
if you think this is accurate.
Okay.
I think the first question is, what else are you going to do with that money? Right.
Right.
So when I'm thinking about this investment, I just had a real good conversation with a buddy of ours that listens on the podcast, Greg Buckland. Shout out to Greg if he's listening right now. But I was just kind of thinking that when you think about what else you're going to do with the money, if as long as the numbers are still penciling out in the short term to have average out to like break even or slightly positive cash flow for the year,
Mhm.
then I'm a big believer that it's going to be interesting for the next 2 years, right? Like next 2 years, things are going to get weird. The stock market's going to do crazy things. All the other investments are doing crazy things. If you can get into real estate now, because you have the money and it's like this, put it under your mattress, you're going to lose money on inflation, right? Like putting it in the stock market, it's going to go for a roller coaster ride. Putting it in real estate right now, I think in the next 2 years, I'm not sure what's going to happen, but I'm pretty certain that in Jacksonville, in the next 5 years, we're going to be in a place where properties will have gone up in price.
Mhm.
Interest rates will eventually drop, right? Like from where it's going right now and when it is right now. And once that happens, the property prices are going to be going even higher. So when I think about like what else I can put my money into, I'm thinking of like, man, what's not going to give me heartburn for the next 2 years that I can put my money into? And then where can I be in the next 3 to 5 to then be able to capitalize with the rest of what I got going on? And I think of this asset class as like, if I'm putting my money there in the next 5 years, there's going to be an opportunity to refinance or, do something with the equity that you will have built up. And when the rates go down and, like you can change those parameters, keep your investment and then do other things if you get in now based on all that. What do you think about that?
No, absolutely. I agree. And Hervé is a proponent of refinancing and reinvesting the money that he's getting from the refinancing. But if you're in my shoes or in Ken's shoes, where you're looking to be able to live on the 5 houses of the inflow and the income from that, the cash flow, I meant to say, then that's supplementing my income until I can establish more money coming in to be able to buy more homes. The object of what you're talking about is to be able to sustain what you have and build on it moving forward. And that's absolutely what you're talking about in reinvesting money into, I do see what you're talking about. I do see prices increasing. Do I think it's ever going to get to a point where it's Miami? No. Right. I don't see, $1 million homes in these C-class neighborhoods because nobody be able to afford them. Or I don't see inflation going that crazy that a dollar amount is going to be that devalued that the house's valuation is going to be moving up that much higher. And that's just the analytics, right? So I
Yeah.
agree with you 100%. What you're talking about is the way to do it. You leverage the equity on the house. You can't buy a cup of coffee with equity, but you
Yeah.
can trade that money in,
Yeah.
trade that in and make money and make the money work for you. That's
Yeah.
absolutely right. Yeah.
And if I just put myself in Joe's headspace, right? Like he's saying that he's financially ready and is just trying to take the hurdle. I just think of like the longer you wait to take the hurdle, right? Like having it in the bank account, it's going to lose money to inflation. And if I had that money and I was going to put it right now in the stock market, man, I just don't know how I'd sleep well. Like I have a hard time
Losing
thinking that
money.
I want to go in on the stock market right now, right? So it's like, do you want to hedge to like not lose that much? Do you want to gamble to like maybe lose a lot and maybe come back? Or do you want to preserve capital in the short run, increase, like turn that equity into a little bit of income and come out in like 4 or 5 years and be like, okay, now I'm sitting on something that has gained some equity and there's going to be interesting thing happening with interest rates later on. I don't know. That's
What Joe is thinking about is he's got these internal demons that are barking at him saying, oh, I wouldn't do that. Oh, if you just wait until, you know, whatever the XYZ is, right? Something's going to change. It's going to make me want to do it. You're never going to get to a point where you say, let's pull the trigger, let's drop this thing, let's get this thing going, right?
Yeah.
The hurdle that you have to get over in your head is, does this make sense? That's it. Does it make sense? And it either does or it doesn't, because the people that are telling you all the time, why would you want to do that? Why would you want to do that? The month after you do it are going to be the ones that say, why didn't you tell me to do that?
Yeah.
But it's the same people. Once they see, oh my God, look how that did for you.
Yeah.
The same people are saying, why didn't you tell me to do that? Right? I mean, no matter when you invest, you're always going to have somebody that's going to say, don't do it. Wait, you should wait for a better opportunity. There's never a better opportunity. It's always right now.
Yeah, it reminds me of that. Shelly just took the words out of my brain, right? It reminds me of that old saying, don't wait to buy real estate and wait, right? Like that's kind of what I'm thinking. All right, we got a bunch of Q&A in here. Oh, first, let me just show this real quick. We have the sheet here, Joe. So, you know, it looks here in the, if you go into the analysis, conventional financing, you'll see that the assumption is 6%. There is the numbers are still penciling out. Average monthly cash flow over the 10 years is still 229. There is I believe it, let me see. I'm not as skilled with this thing as Greg normally is. What am I looking for to see?
Total IRR is 12.1%.
Yeah. So penciling out, right? Annual cash flow, right? Like it is positive, averaging positively over the years. So to me, I think the numbers still do pencil out according to this thing as well as I understand it.
Yeah. And if you're looking at, putting 30% down, your total investment was the 79.9 over whatever it would be over, your rent coming in, non-taxed, right? So your rent is, what was it?
Rent should be in the summary page, right?
16.9, it was 1694. So 1694 times 12 would be divided by how much you put out, which would be the 79% plus closing. And that would give you your rate of return. So in this case, it's 12.1. That's great. That's how that's calculated, right?
Yep.
So people are always saying, how do you get that number? Where is that coming from? That's how you can quickly come up with that.
Got it. Cool. All right. So we got some more questions here that I think are for you, man. We got 10 questions. This is you're bringing up the good stuff here, Lee. All right. Michael Santorios. Lee, did you do, or I'm going to save your portfolio questions till afterwards, right? So Leo Faraganan is saying, I got a loan out of my traditional 401k for my work, actually used a loan for my first JWB property. I paid half of that loan already, but I like to see what other options I have for my 401k. I tried borrowing again, but I have to pay the loan first completely. Any recommendation?
You had to pay the loan again. You have to pay the loan off before you can borrow against it again.
I think that's what he's saying.
Refinance it, but you can refinance it, right? Because I've already refinanced it to improve my cash flow. So my cash flow was 80 and I refinanced it. I found somebody who was willing to refinance a, what do they call that? A non-traditional loan, right? Because it's in a retirement account. I found somebody that would refinance it for me. And my cash flow went from $80 a month per house to $250 a month per house. And I have a longer time to pay it off. So the payment went down. The interest went up slightly, but it generated more cash flow. And that means I can pay them down faster. So it doesn't matter to me if it's 50 years, 30 years, 20 years, as long as it's generating positive cash flow, I plan on paying it off in 3 to 5. Right. So doesn't matter to me what the rates are, as long as, everybody's out to make money. I'm going to make mine quicker. So that's what I would say. If he's trying to get the loan and he needs to pay it down, if he refinance it, however much it costs to refinance it has to be taken into account. But for me, for my 4 houses, it made sense to do that.
There you go. All right. Billy Green in the mountains of Colorado is asking, many of JWB's managed properties are leased for over 4 years. What kind of maintenance is typical to do in getting the property ready for the new renter once such a long lease is over and taken on with a new renter? Have you had a turn yet, Lee?
I had one turn out of the 5 houses, and my turn was $1,500. It was incredibly low.
Pretty cheap.
And why was that? Because it was it was on Broxton Street, and it
Mhm.
was the manager of the processing plant that was right across the street. And so I guess when he left, the new manager came in and he took it over. But
Yeah.
the turn was minimal. And that was because, you know, we're vetting the right people to get them in, right? JWB is making sure that you get the right type of people. Plus, I think it has to do with the 3-2 configuration. You know, I don't have an extended family living into the house. Not that there's anything wrong with that. For me, that's not what I'm looking for.
Got it. Okay. I think that sounds low. I think, Madison, I don't know if you know the number, but the average turn is maybe like 2,500, 3,000 bucks, something like that.
It's,
5,000.
yeah, it's right now it's between 45.
I was way off. All right.
5,000.
4,500 to 5,000. Okay, cool.
Yeah.
Yeah.
That's
there
what I
you go.
was told, right?
Yeah. So there you go, Bill. So that you definitely want, like, I know that I want to have, I've told myself I want like, 15 grand in a rainy day fund of just like, in case stuff happens, I have 3 homes and things going on. But the more homes you have, the more diversified you are, because the homes, you know, cash flowing today pay for the one that's vacated, and they're generally not going to be, you know, all in a bad place at the same time. Right.
Right.
Cool. So Sir Jeff Bolton is this one break even? The deal sheet shows cash flow that does not include turns and maintenance. If you include those, isn't it negative for at least a few years? If my thinking is correct, would you increase equity or look for another deal? So Jeff, when I look at this thing, I
It does
see,
show.
yeah,
positive.
correct. I see, if you look here at line 26, I see vacancy costs every single year. They're just kind of like averaged out. Right.
Right.
And I see maintenance and repairs in here every single year. You
Greg
see,
said that he builds that in at whatever 3% or 5% for the maintenance every year to count for when you do have a turn. So that is taken into account.
yeah, so they are taking into account here if you look at lines 26 and 27. So what was
And it's still positive cash flow.
and it's
every
still
year.
positive cash flow. Yeah, there you go. And if my thinking is correct, would you increase equity or look for another deal? If, let's say, it was a cash flow negative situation, would you increase equity or look for another deal?
To be honest with you, I would, if I were interested in that house and I wanted to have more cash flow, I would put more money down toward it. If that's what you're looking for, only you know what you need in retirement and what that's going to generate and what your cash flow is going to be. And that's how you calculate this stuff out. And that's why you do the due diligence of looking to see what kind of configuration you want for these houses. So you're the answer for that. Whoever you are that's asking that question, and everybody should be asking that question for themselves, right? What do I want in cash flow, you know, when these houses are paid for or when I retire? Because if you're 30 and you're buying these houses, you have a 30-year mortgage. By the time you retire, you're going to be getting whatever the payment is at that point. Rent never going down, according to Greg, right? So in the history, the houses prices are always going up, but the rents always stayed the same and stayed affordable. So
there you go. Great explanation, man. Ria Patil has a question. Ria, that's a new name that I don't recognize.
New name.
So good to have you. New name. All right. She's got a couple of questions. Are property prices in Jax likely to rise or drop in Q3 or Q4? Lee, look into your crystal ball. What do you think?
I think they're going to rise, to be honest. I mean, you know, because they have, you know, maybe not dropped or stayed, you know, I mean, they're always rising, right? Property prices are always rising because materials are always rising to build the houses, you know. So, I mean, it's always going to be a positive. I mean, nobody's going to experience the crash they had in 2007. We're just not going to let that happen, right? As a market. And if we can control it as much as we can, looking into my silver ball, I think prices are going to go up. It just has to. They have for me. I don't see why that trend is going to stop.
Yeah.
You know,
Ria, you're asking us to guess, right? Like that is not my guess. This is total guesses, right? But what we track here on the show a lot is months of inventory. And what months of inventory will tell you is that if you are at the historically average months of inventory rate, then home price appreciation should be at the historical average. The historical average months of inventory rate is somewhere around like 6.5, a little bit more than that. And the historical average appreciation is 4.6% appreciation. Right now, we are still well below the historical average of months of inventory, which should tell you that in the short term, prices will continue to rise. So, you know, and to give you the other side of the coin, it's not like if once it goes over 7 in months of inventory, it starts going down, it just starts appreciating at a lower rate than the historical average, right? So the idea that we're going to get to a point where homes are going to start depreciating, you'd have to get to very, very high months of inventory numbers. And that's just not what we're seeing right now.
You might see that 30, 50 years from now, but not now. Prices are always going to go up. Even when, if you look at it, even when interest rates were at 10 and 15%, the prices of houses were still going up.
Yeah.
You know, it's whether you can afford it or not, is whether or not, you know, that increases the inventory, right? Or
Yeah. And the caveat is there is seasonality in people that are buying houses for their residents, and there's seasonality in investors looking for deals that are very, very active. If you're taking a passive approach and buying from a turnkey company, the odds of the house price going down is very, very low because a turnkey company is buying it right. They will just hold on to it before they sell it again, right? So if you're going to be active out there looking for someone in trouble, maybe as the economy turns, you can find a good deal. But if you're trying to take a passive approach, it's not going to happen. Ria's got another question. I know it depends on how much you put down, but on average, how long does it take for a JWB home to be paid off and start collecting more than a slight positive cash flow? Lee, if you don't mind, I've got a little bit of perspective on this one. We put together that Karate Kid presentation where we showed, there you go, Mr. Miyagi, where we showed kind of like how cash flow increases. So you're asking two things. One is, how long does it take to be paid off? That definitely depends. We did do a recent show where you can do rapid pay down via C3X, and we've seen houses get completely paid off in 23 years, or if you're buying one cash and then paying another one down with the cash flow for that, even in like the under 15-year range. But what you see if you're just buying a conventionally financed home and not doing anything really super extra there, what you see is that right around year 10, your cash flow is already significant, right? Because you've had multiple rent increases while your expenses stay the same. So by year 10, you start seeing cash flows already be as good or better than bonds. When you start getting to like year 20, it starts really beating the pants out of bonds and all that good stuff. And then year 30, when the mortgage is up and paid, your cash flow becomes your entire rent, right? So anything to add there, Lee?
Oh, you almost called me G.
I'm gonna call you Lee C. Lee C.
Lee G. Oh my God, you're going to be in trouble, brother. No, you know, I mean, the only thing I would add would be it may not be significant, but if you do a refinance for whatever reason, you can increase your cash flow, which I did. But if you have a conventional loan, you can always find another lender that's going to give it to you less, that you don't have to go through JWB if you want to go that route. But again, you're laying out cash, and you have to take into account how much that cash is going to offset how much your return is going to be. And if it's significant, then you do it, right? If you think that your rate is going to get better, because your expenses are always the same, right? They're always going to be down here, and rent's always going to be growing, right? So that's how you have to look at that. So after year 1, you're going to be making money. If you're not, that's the way I look at it. After year 1, if you can afford to not be making, you know, even a positive cash flow of $15 a month, by the time you pay taxes and insurance, it's going to be more. You might be ending up like $2,000 in the hole for the first year, which we have seen some houses like that. But after year 1, after year 2, you're going to start seeing positive cash flow. That's the way you look at it.
There you go. There you go. And it's, you know, every rental renewal, you know, like every year rent goes up. That definitely goes up, right? So,
Right.
and your cash flow stays the same. All right. Doug Lowenthal has a journey question. We're going to save that for the journey side. Roger Evans has one more before we get into your journey here. Hi, Lee. If the interest rate is rising, property purchase price is high, and your cash flow is very low to even becoming negative, would you purchase the rental investment at this time?
So is he
Interest
talking
rate is
about this
rising.
house? Is he talking about this house?
I think he's talking about
Could
I think those are the real conditions that are happening right now, right? Interest rates are
Yeah.
rising, property purchase prices are high, cash
Right.
flows are low. Would you still purchase a rental property at this time?
Absolutely. Yeah, no hesitation. You know, and the reason why I'm saying there's no hesitation is because JWB honestly is taking the guesswork out of it. They've done the homework for you. They're not going to sell you a house that is going to kill you in your, you know, negative cash flow, right? And they're going to try and make it as much as break even or positive as they can. That's the under, you know, promise and over deliver process that I believe that they stand by. You know, I mean, that they don't really, it is about the company, right? And you have to have trust. And we all do in this podcast, all the ones that are talking all the time, all the ones that know what we're doing. If you see these guys talking, you know, me included, I'm popping stuff out there. We have all the confidence in the world that they're not going to sell you a subpar you know, project or, you know, widget or whatever you want to call it. You're always going to be getting something that's going to give you a return. If not the first year, definitely the second year. So yeah, now would be the time to buy. The only time not to buy is never, right?
I don't know. Well,
If you
he's
say-
also talking
if you
about the
say I'm
deal
not going to
specifically,
buy a
right?
house, right?
Or in the wrong market or not
Yeah,
having
oh
a good partner.
but we're
Yeah,
talking
yeah.
about JWP houses, right?
Yeah,
So
yeah.
if I'm looking in Texas, are the houses are pricing are $500,000 and up, right? And I'm looking in Galveston. Galveston, the prices last year were like $700,000-800,000 for a house, and that's fine for if you want to make that an Airbnb in a beach area, which a lot of people were buying. But that's where I'm looking to buy a house, and I'm waiting for the prices to drop down. So I'm not looking at an investment house there. I will be, but right now the prices are dropping again in that area because they were so exorbitant.
Yep.
That my new house is, once I sell this one in Baltimore, I'm going to be living in Galveston, and we're going to be using the money to do that and see what we can come up with as far as finances that might be, you know, seller finance, right? Find somebody that's upside down.
Yeah.
Its valuation was so crazy.
There you go. That's interesting.
I don't know if that answers your question or not, but
I think you said yes. You said you would still buy, right? Like
if it's an investment home, you buy it,
Yeah.
right? In the right area with the right manager.
And I know he asked you, Roger, I'll chime in. To me, you know, what you're saying here, interest rates are rising, property purchase is high, cash flow is very low to maybe even slightly negative year one. I would put that in the contest. To me, the key here is interest rates are rising. So if you believe interest rates are rising, I would buy now, right? Because you're going to buy something and you're going to lock in that interest rate, and maybe year one is slightly negative cash flow, but as the years go on, this thing ages like a fine wine and it's going to increase cash flow, right? So if you believe in the fundamentals of the rest of it, and it's just like the first year cash flow being even and interest rates are going to rise, then you're going to lock in good money to like be able to get into a positive cash flow position sooner. The counterpoint would be, if you wait, interest rates are going to rise, that cash flow is going to be even more negative. So you'll probably never get into, or you'll wait longer to get into rental properties. Doug Lowenthal has a great question. He says it might be a silly question, but I think it's a great question. He says he's new to this. If you had, let's say, $250K and you wanted to start investing with JWB, would you do the minimum amount of down payments to get as many properties as possible? Or would you do something different? I'd love the chat to give each of your opinions on that. What's your opinion on that, Lee?
Well, in any case, you have to make sure you have enough reserves to be able to handle contingencies, right? I just had to put in a water system that was $1,500. And, you know, if you invest all of your money, all of that $250,000 into buying, say, two houses at 50% down, or if you get a non-recourse loan, it would be 40%. You can talk them into doing a house for 40%, or conventional 30%, right? If you're talking about 30%, you might be able to get 3 houses. And I know JWB has some lesser price houses, not lesser value, lesser price houses that are, you know, refurbished houses. You might be able to get 3 or 4 at a conventional loan. And I would do that. But the key is, the more you have, the less you have to worry about covering for all of your rent at any one time, right? It covers that 3%, it covers that 4% for all of your houses, because if one is non-performing for a month, you have extra coverage to be able to pay that bill, which is always going to be there until you pay the house off. And that's, you're leveraging your coverage by buying more houses. So absolutely, I would do that. If
Yeah.
I had $250,000, I mean, I had $500,000. I bought 5 houses, non-recourse loans, and they
Your
wanted
answer.
to put 50% down.
Yeah.
But I'm saying if you have 250, you should be able, this house here that they're talking about, you have to put $60,000 down. You have to make sure you have closing costs for it, because you can't just add if it's conventional, you can do that, right? You can do whatever you want. You can even roll the closing costs into the house.
Yeah.
Or you can pay down like JWB was offering to do. You can still do that, pay down to get your interest rate down.
Yep.
And some people will still do that, right? You don't have to do that. So the short answer is yes, I would then short buy
You'd buy multiple homes.
2 or 3
Is your-
houses.
Yeah. I feel like your answer was, hey man, scoreboard. I had 500 grand and I bought 5 instead of just buying 2. Right. So
Right.
it feels like that's what you would do. I would add the caveat of, for Doug specifically, Doug is a young guy and, I think he's in it for the long run here. It does feel like for him, the right answer is to leverage as much as possible and stay cash flow positive, have a diverse portfolio, right? I think with 250 cash, he can buy at least 3 with 25, 30% down, be positive cash flow, have that, I know that Greg, when he was giving me advice, he was telling me, you want to get to 3 as quickly as possible because that diversifies you within the asset class. And that really helps. So that seems like the move for Doug, based on the fact that I know his situation somewhat, but there is the other side of the equation is if you have 250 grand and what you really need is the cash flow today, maybe the answer is to, buy 1 in cash or something like that. But Doug is in it for the long run and he's a young guy.
If he's a young guy, why not get the 30-year loan, right? Put the least amount you can down, you get 3 homes.
Yeah.
Get them going. Yeah.
Yeah. Got it.
Good,
Cool.
Doug, if you do that. Woo, woo.
Let's go, Doug. Think of a bundle. All right, man. I'm gonna jam through your client journey really quickly because I think there's just been so much value in you answering these questions. But I want you to have the experience of the client journey thing since you're the MVP. Lee, here is your portfolio. I know you're familiar with this. You picked up this home over here in November 2019, and then you turn around and said, you know what? I want 4 more in December of 2019.
1 month later.
I find really interesting here, these like purchase prices, 160, 155, right? Like very different than the purchase prices today. So you acting quickly, right? Real estate goes up, looking pretty good there. Couple of questions here to answer Santorio's question. And Ken, you bought these all inside your retirement account. Tell me a little bit about like buying it inside the retirement account and how you thought about it.
Okay. So I set up a solo 401k LLC, and I have signature authority over that account, over that company. And with the signature authority, I was able to transfer money from my 401k into a holding company and then back into this checking account, so that there was a flow of money going from one 401k to another 401k. And then I was able to talk the lenders into me only putting 40% down. And that's why it's 62,000 and lending 93,000.
Yep.
But the first house, I owe 25,000 on it right now.
The first house you owe 25,000. So it looks like here you bought
On the mortgage. The Broxton Street, I owe 25,000 on that.
Okay, cool. Yeah. So to answer
total
Ken
about
Moline's
9.
question of your mix of own versus financing, you bought the
Yeah.
first one cash and then you financed 4 of them, right? Like this is kind of what you were talking about. You had $500,000, you bought 1 for 160, and then you bought the other 4 levered up with a mortgage on there. Bill Green wants to know, are you using any kind of like rapid pay down strategies?
I'm doing the C3X pay down. Yeah.
Okay. There you go.
All of them, once I refinanced, everything went into that last home. I'm now paying that last home off or the Broxton Street home off. Like I said, I owe $25,000 on it.
Mhm.
Once that's paid off, then I think by the time I get 3 paid off, it only takes 6 months to pay the rest of them off.
Yo, dude. So man,
Right.
that's
Right.
that's
I mean,
that's
does that blow
incredible.
your mind?
Yeah, so it already blew my mind that you already paid off more than half of your mortgage on a property that you bought like
Yeah.
4 years ago,
Right.
less than 4 years ago, and you're about to be completely, if once that one's paid off, you paid off the rest in how long? So say
So,
that again.
yeah, so right. Yeah. So the all of the loans are being paid off, right? So, but it's minuscule, right? So I think when I refinanced, I owed 89,000 on the last three. And the first one I owed like 30,000 on it. And I've been paying off that, at about $2,500 every month to try and pay that down.
Yeah.
So once the second house is paid for, then the entire rent from the first house, entire rent from the second house, and then 250 from the other three pay off the third house. Right. Once I get the third house paid off, it only takes 6 months to pay down the other two houses, the next house, and then less like 3 months to pay down the last house, because you
Epic, bro.
put all that much money into it. That's the trickle down effect. And that's how, that blows your mind.
Yeah,
What
that's
really blows
mind
your mind.
blowing. Like I'm trying to do the math here. Forget it. I'm just going to go into this conversation. Anybody wants to know about that? That's the C3X method. We talked about that a couple of weeks ago on a past Not Your Average Investor show. So look that up on the podcast. Look that up on YouTube. We talk about all these different financial engineering mechanisms. That was one of them. And then we have a past show like maybe a year and a half ago with Paul Shively, really going deep into that. But a very interesting rapid pay down method that you are maximizing, bro. So all right. So this is the house with the highest ROI, not including appreciation. You 3012 Water Street. You got an annualized lifetime return of 6.65%. Anything you want to say about this house?
Well, that's the one that I visited during the tour in February.
Yeah.
And that's where the one we just had to put the water treatment into it. So it's septic and
Was it?
well. So
Cool. And then this is the lowest performing home that you got. Looks like a couple of rough years here, man.
yeah, there were some things going on with the septic that I had to have. Plumbing needed to be worked on a couple of times. And that's why. That's
Yeah.
all.
And then this 2019 is you bought it at the end of the year. So like that's like all the down payment.
That's a wash.
Yeah, that's a wash over here. And here is your total portfolio review, man. You have this total net rental income since 2019, right? So this is December 2019. We call it 3 years, right? Like you've been in these homes for 3 years, $32,095 in total net rental income. No tax savings because you bought it in your retirement account.
Right.
Yeah, correct.
Yeah.
Total principal pay down so far, because you've been crushing principal pay down at
Yeah, that's
20,714. Yeah. Yeah. I mean, listen, it just shows all the different ways you can do it. Total home price appreciation of
Right.
$435,000. That's
Right.
nice. And the beating the, I don't really know how to describe this, like consumer price index.
Inflation hedging. Yeah, 6.0%.
Inflation hedging. Yeah, you've been at 6%.
I'm earning more than that.
You're earning more than that. And at the end of the
Right.
day, your expected return on investment based on buying it in your rental portfolio was 2.9%. Your
Yeah.
actual return on investment when you include all 5 profit centers, 22.1%, crushing your expectations. How's that feel?
Right. Oh yeah. It's always amazing. No matter how many times I get on this show and Greg talks about it, it's always fun to look at this stuff and say, man, I rubbed the crystal ball and I came up on the upscale, right on the upside. But to be honest with you, buying when I was 58 and knowing that I'm going to be retiring and using this money for, as a supplemental income for what I'm doing, I don't have to do much to let this thing keep working for me. So I will be buying more properties. I said that I wanted to buy 20.
Yeah.
And that has not changed for me. Even though I'm 67, once these are cash flowing,
Mhm.
I'll be able to do the same thing with 5 more and be able to do the same thing and roll that stuff in. So it's legacy. So I'm never going to lose this and always going to be able to turn it over to my son and my nephew.
I love it, man. That's a great outlook, right? Because most people, we talk to people in their 50s, late 50s, and they're like, man, I wish I would have started 30 years ago. But like, you as an engineer, as a financial engineer, you're able to look at it create a way to rapidly pay this thing down, jump in. You've had all of this success already in just 4 short years. You're creating more success for yourself. You're going to keep doing this thing. Pretty awesome. We like to go over the 5 profit centers and just kind of show how it works, right? Like we talk about this Pac-Man, right? Like every time we have a guest investor on here, we show the 5 profit centers and we show this slice of rental income, which, it's half of the mouth. Principal pay down's another half of the mouth, but it's not a very open mouth. And the Pac-Man itself is home price appreciation, which makes up the majority of your returns, which is why we tell people to invest in a growth market. I want to ask Doug Lowenthal's questions right now, because I think it's
that's cool.
Is germane. Can Lee share any lessons learned of things he wishes he would have known or done differently now that he is 5 houses in?
Jesus, if I wish that I was 30 and knowing what I know now.
Yeah.
I'd be like Greg. I'd have like 40 or 50 or 300 houses. I don't know, but yeah, I mean, the lesson learned is help people get over the fence, right? I knew what my reservations were and got over them, and being able to talk to other people and get them over their reservations is a lot of fun for me, because I do spend time talking with a lot of people and asking them, what their reservations are, or they'll call me up and they'll say, how did you do it? What did you do that was so special? It wasn't special. It was timing. Timing was everything. And that's why I said there's never a bad time to buy. It's always right now is the best time to buy. If you got the money, if you have something set aside for a rainy day and you can afford a home, don't let it collect negative money sitting in your bank. I mean, you're losing money when it's in your bank. You're paying your bank to sit and hold your money. Why? You could put it under your sofa, and hope somebody doesn't steal it.
Yeah, Lee, I mean, if I was to summarize what you're saying, it sounds like you're saying is 5 houses in, your biggest takeaway is you're super happy that you took action, and anybody sitting on the sideline, like you're kind of, I mean, you're doing a wonderful sales job for JWB, right? But like you're nudging people to take action, and this idea of like, you were 5 houses in, you're happy that you got in when you did. If it was now,
I know I'll be investing. I know I'll be doing more investing. I'm not done with the investing side of it. I won't be investing with retirement money. It'll be passive still, but I'll be using my active money that I'm generating, with my business to buy more homes. Like a lot of people are doing. Andrew is doing it. I know, just people that we talk to all the time in the chat. I know that they're not done buying. Nadine, not done buying. Hey, I got to give a shout out to my girl Helen Duquet, who I know is working today, but she's watching the podcast. She sent me an email asking me if there was anything I needed from JWB before I got on this call. And I just think that's pretty cool, that my girl is taking advantage of, not taking advantage. She is helping. She's doing whatever she can to help me be a better me on this show. And really, the only one that makes me a better me on this show is you, Pablo.
The only one that makes you a better you on this show is me. I'll take it, bro. I'll take it, man.
Yeah, right?
I don't even know what that means, but I'm into it, buddy. I appreciate you so much. Jeff Bolton has one more question on the sheet. Jeff, yeah. I'm honestly not the best person to answer this, and diving into it right now is probably going to take too long. I know Madison is going to put you in contact with your portfolio manager so they can explain that to you. But yeah, Bill, you know what? We are going to do a show. Bill's saying, I want to see Pablo's portfolio. We are going to do a show on my portfolio this quarter. I know that there's a past show that showed it, and we're doing another one coming up. I don't know exactly what the dates are, but it is in Q2. So you'll get to see that as well. And I want to see it too, because Greg does all the whiz bang stuff that I don't know how to do and tells me everything that I need to go tell my wife of why I'm smart that we put this money in here. Even though she's the one that really, I got to give it to her, right? Like she was like, you've been talking about doing this. Are you really going to do this? And she kind of pushed me along. But yeah, anyways.
Everybody needs somebody.
Everybody needs somebody, man. Lee, yeah. You are that somebody to so many people, man. From being the first guy to be the super fan of the show to hopping on with Jen and helping her figure out a another situation to people that have nothing to do with this community that just show up randomly in your life and you help out, man. And I just really want to acknowledge you for that being that somebody for people, man. You're such a giver. You're such like a bright spot. Your smile is uncomfortably loud and lights up a room. I mean, your laugh, but it's addictive, man. So I just thanks for being you and being the MVP of this thing and showing up to do this show and wearing glasses so that you look more like an engineer. All the things that you do, man. I appreciate you, bro.
The glasses, man. I took notes. I was all ready for this show again, you know. I prepare, brother.
Yeah, it's
Can't
awesome,
let you
man.
down.
Yeah. So thanks a lot. Thank you to the community. We had a great crew here. Really good questions, man. Like awesome questions today. We're seeing new people show up every day. We asked for you to do reviews of the podcast, like go to the Not Your Average Investor show on Apple, iTunes, or Spotify. A bunch of you did already. So thank you so much for doing that. Anybody else that wants to do it and join the other Not Your Average Investors that are doing it, we'd really appreciate it. It really helps us grow the show, which it's doing. And we can see it because we're getting new people every day, new questions. It makes the show really, really much better. Somebody showed up late, asked how many houses you had. Miguel did. You got 5 houses. Lee's got 5 in the portfolio. So, but thank you so much for doing this. On Tuesday, we got Kelly Berenbaum coming up. I've been dying for this show. I've been asking Greg, I want to talk to a financial advisor to tell me why financial advisors don't generally advise on real estate. And I met Kelly at the IRL meetup. She is a fiduciary financial advisor that I think is the right way to do financial advising. And she's coming on and she's going to tell us not just why financial advisors in general don't really understand this asset class, but how to talk to your financial advisor, how to pick a financial advisor, how she herself as a financial advisor analyzed the deal. She talked me through her whole formula. It was fascinating. So Tuesday's show is going to be awesome. Hope to see you there. Lee, I want to give you some last words here.
Oh my God. Last words from me. If you don't want to be an average investor, no, I'm saying it wrong.
Man, that was perfect. That was perfect,
good, brother.
Yeah, that was perfect.
Man.
Whether you are an engineer by trade or a learned engineer like Lee is as a network engineer, or you want to be a financial engineer, the one thing that you can't be to hang out in this community is what, Lee?
Don't be average.
All right, see y'all Tuesday.